But
Yeah, I know that
desperate
too.
times call for desperate measures. So
There you go.
So I'm just going to use the mute on my telephone so that because I don't know how to do this, the #6 or *6
right,
muting
you
and
don't.
unmuting.
I wouldn't even do that. Just leave it up, Kerry. Screw it.
You can certainly use just the mute button on your phone that you are familiar with, no problem. You will be in total control. I am not going to have Adobe mess with muting you or unmuting you at all.
Right.
All right, well, I don't think that we need music since we just have a few minutes until we get started.
Am I correct? We've only got about 21 participants?
That's just right now. We had over 100 register, and you'll see.
Oh, we got a guy from Bank of Oklahoma.
What? Lindsay, can you hear me? Lindsay, can you hear me now? Ian, can you hear me?
I can.
Okay, great. We somehow had a little audio connection blip, but we should be good.
How about Kerry?
Yes, I'm here, and I could hear her fine.
Cool.
All right. Let's just, I'm getting some feedback from others that are participating just as participants so we can make sure everybody can hear. And it's now 3 o'clock, so we're just going to go ahead and roll with this. Welcome, everyone. My name is Kelly Graham with University Conference Services. We're thrilled to welcome you all today to this webinar. We're thrilled to partner with DLA Piper, Ian Kopelman, a longtime friend and speaker at our programs, and a new partner, Kerry Eason, also of DLA Piper, are going to present some great information today. Just a couple of housekeeping notes to start off with. First, we do recommend that you listen through your computer speakers. If you need to call in, the phone number is listed right there in the Q&A pane. Also, the Q&A pane is a great resource for all participants to write in their questions to Kerry and Ian. They will get to as many as they can at the end if possible, or they can follow up with you afterwards with any specific questions that you send in that they're not able to get to. Your questions that you submit are private, so other attendees cannot see your questions, just Kerry and Ian. Today's session is being recorded, and so we will send out an email tomorrow with all the continuing education credit information as well as a link to the recording. As I said earlier, we're thrilled to have Ian Kopelman and Kerry Eason with us today. Both are seasoned benefits attorneys and are going to present a wealth of information regarding these two important acts. And with that, Ian, I'm going to let you just jump right in.
Well, thank you, Kelly, and welcome, everyone. It is a pleasure for both of us to be doing this session, although I must admit it's a whole lot different than doing them in person. With that being said, let's move to the agenda. and what we intend to do. So, Kelly, if you'd move to the next slide. What we hope to do in the next hour is give you an overview of the provisions of the Secure Act, which is the act that was adopted at the tail end of last December, and particularly the portions of the act impacting retirement plans. We'll then move into those provisions of the CARE Act that impact retirement plans and also health care plans. As you may recall, the CARE Act is the act, the statute that was passed by Congress about 2 weeks ago, which was intended to ameliorate the financial impact of the pandemic. There were a couple of provisions in the retirement, in the CARE Act impacting retirement plans and health plans. When you look at as we go through the provisions of the CARE Act impacting retirement plans and the Secure Act, you'll notice that they don't work together. They're confusing in their effect. The reason for that is that the intent of the Secure Act was to encourage additional contributions to retirement plans and additional accumulations of retirement plan assets. The provisions of the CARE Act dealing with retirement plans, at least, were intended to give individuals who were detrimentally or who are detrimentally impacted financially by the effect of the pandemic an ability to reach money. So one act encourages people to put money in the plans. The other act enables people to take money out. So don't think they're going to work in tandem. In fact, some of the provisions conflict. Let's move to the next slide. One more after that. There we go. What I deem to be one of the most important provisions of the Secure Act when looking at its impact on plans and also service providers and how they provide services to the plans are the provisions permitting the expansion of the use of multiple employer plans, MEPs, and pooled employer plans, PEPs. I say multiple employer to distinguish it from multi-employer plans. Those are union plans, and that's not what we're talking about here. A multiple employer plan is a plan that permits adoption by unrelated plan sponsors and participation by participants of those plan sponsors. We've always had MEPs, but their use has been very restrictive because of two rules. The first rule is that though unrelated employers were able to adopt, those employers had to have a nexus, that had some relationship with each other. So for example, a law firm in New York could adopt a multiple employer plan with a unrelated law firm in California because there was a common nexus. They were both law firms. A law firm in New York could not adopt a multiple employer plan with a restaurant in California because there was no nexus between the two. That's what allowed, for example, trade associations to set up a plan that could be adopted by participating members of that association. But, of course, it was restricted because of that nexus rule. The second rule that restricted and impeded the adoption of MEPs and PEPs even more is what's known as the one bad apple rule, which meant that if there was a disqualifying event which occurred with respect to the portion of the plan adopted by one unrelated employer, it could taint the entire multiple employer plan, including that portion of the plan attributable to the participants of a different employer. Both the Nexus rule and the one bad apple rule have been repealed by the Secure Act, effective for plan years beginning after 12/31 of 20. So now, unrelated employers can adopt multiple employer plans without there being a nexus between them, and a disqualifying event with respect to one adopting employer may disqualify that employer's portion of the plan, but it won't disqualify the multiple employer plan as a whole. Let's get a little perspective here in terms of its impact. When I got into the practice of law, sometime a couple of months before the passage of ERISA, now I think sometime back during the administration of Ulysses S. Grant, you very rarely saw anything other than an individually designed and drafted plan. Over the years, you started to see the proliferation of prototype plans and master plans for small employers and small plans, and the definition of small, the size of the plan that would adopt those prototype and master plans got larger and larger as the decades moved on. With the concept of multiple employer plans, I think that the proliferation of multiple employer plans as opposed to individually designed plans is going to explode over the next couple of years, both in terms of the number of plans and the size of plan that will adopt them. Why? Because they're going to be cheaper to adopt, they're going to be cheaper to run, they're going to be cheaper to administer, and they're going to be less dangerous from a point of view of liability, because the plan sponsor is not going to be responsible for a whole lot of things that the functions that will be taken over by the sponsor of the multiple employer plan. That's going to have a tremendous impact on the number of plans and the cost of plans in the country. But it will also have an impact on current plan providers. It's going to change the way they do business. And if they don't change to accommodate the proliferation of retirement benefits provided through multiple employer plans and PEPs, I think that in terms of their business models, they're going to run a risk of being left behind. So I think this is going to be have a tremendous impact. The key is that the entities that provide the multiple employer plans and PEPs are going to have to be very creative in terms of building in enough flexibility to allow those programs to accomplish the goals that each of the individual employers that want to adopt them want to have. It's going to be an art rather than a science, but it's really going to be a game changer, I think, for the industry. There are all kinds of other provisions that we're going to try to touch on in the Secure Act, such as the ability to do common 5500s and, among different employer plans, and the increase in penalties that can be for failure to file certain notices and annual reports that we will touch on. That can also be accomplished by a provider of a multiple employer plan, although it's not that's not limited to multiple employer plans. That will also encourage employers to adopt these multiple employer plans. So it's going to be a very, very, very interesting couple of years. For plan sponsors, keep aware of what's going on in this area, because it frankly can save some money for you. You will note that the Secretaries of Treasury and Labor are directed to draft rules permitting combined and aggregate Form 5500s annual reports with certain similar characteristics. Those rules obviously have not come out yet, but they will. That's one of the things I was referring to in terms of encouraging employers to get into multiple employer plans. And then the next topic I want to discuss is lifetime income options. First off, there is absolutely nothing in the Secure Act or the CARE Act or anything else that requires a defined contribution or profit-sharing 401k plan from offering a lifetime income option. Any rumors you've heard to the contrary are incorrect. However, there is a provision of the Secure Act that will require defined contribution plans to provide participants with estimates, an estimate at least annually, of the single life and joint and survivor equivalent of what their account balance could provide. These DOL equivalents will be based on interest, mortality, and other assumptions to be provided by the DOL. They have not been provided by the DOL yet, so this isn't something you have to deal with tomorrow. The DOL is also directed to provide a model notice of an equivalent statement, which will grant plan sponsors and fiduciaries protections if they follow that notice. This provision is effective 12 months after the above guidance is published, so I sure don't expect this anytime soon. If the plan follows the guidance, in theory, there's no liability. Now, let me describe for a moment what I think the issue that this raises is. Although we know that the DOL will give us interest and mortality assumptions to permit us to calculate an equivalence, in my judgment, an even more important impact on the size of an account balance over time, and consequently the amount of the equivalent annuity the account balance will provide for, is the impact of both cost of living and merit raises over an individual's career. For young employees, they're presumably going to advance in their career, get more money, they're going to make more money, they're going to have more discretionary income, which will allow them to make higher 401k contributions and give them a bigger percentage of a profit-sharing allocation. And in addition, as people get older, they become more retirement conscious and have a greater propensity to devote a larger percentage of their compensation to the provision of retirement income. I can't imagine how that's going to be factored in to the projection of an account balance and consequently the calculation of an equivalence. What I worry about, excuse me, is that younger employees will see what the equivalent is as it's calculated, find that it's a almost ludicrously small number, and the information will constitute a disincentive for them to make contributions to the plan. Because it's just so small, rather than, tie up the money, they'd rather just go out and get a pizza. That scares me because, as we all know, that contributions that an individual makes early in his or her career have a tremendous impact on retirement. I don't think this was thought through. So I worry about it. The impact of my worry can be, assuming that it's valid, because we'll have to see what the DOL comes out with, can be ameliorated by appropriate employee communication. But then again, to the extent that the employer gets away from the model notice, I'm sure that there'll be a disincentive to ad lib with that notice because they won't be covered by a safe harbor. There's another provision that gives fiduciary relief to the extent a plan fiduciary or plan sponsor actually selects an insurance company to provide for an annuity option that's in a defined contribution plan. The Department of Labor used to take a very tight position on what the fiduciary obligations were when you were selecting an insurance company as an annuity provider, and there was a thought that if you didn't select the safest, regardless of cost and regardless of how you define the safest, the most highly capitalized, et cetera, there could be an issue, a fiduciary issue, if the insurance company failed to provide the annuity benefits when due. The safe harbor provision set up in the Secure Act, which is effective immediately, says that fiduciary responsibilities are satisfied if the fiduciary determines that the provider, which is the insurance company, is financially capable of meeting their obligations after reviewing the company's finances and the cost of the contract are reasonable in relation to the contract benefits. So they did cook in an impact of the cost of the annuity contract. In addition, they require that the fiduciary must give a representation that the security company, that the insurance company meets the statutory requirements under applicable state laws, and presumably, although it doesn't say so explicitly in the statute, but I would assume that the contract purchased also qualifies under the state guarantee funds, the insurance company guarantee funds established by the various states. If you do that, there's the assumption that the fiduciary is satisfied his or her fiduciary responsibilities in connection of the selection. The implication of this provision is that the impediment to the provision of an annuity under a defined contribution plan was the fiduciary liability. I think that was a relatively small part of it. I think the real impediment still is the fact that, annuities are somewhat awkward and right now somewhat expensive to provide in a defined contribution plan, and I think those issues still have to be addressed before the provision of annuities will be in defined contribution plans will be widespread. I think that's the end of this slide, Kerry, so the next one is yours. Let's move to the next slide.
Thank you, Ian. As Ian was mentioning earlier, part of the impetus of the Secure Act is to encourage...
Excuse me, for the prior slide, Kelly. You did too. There you go.
Thank you, Ian. As Ian was mentioning earlier, part of the impetus of the Secure Act was to encourage retirement savings. And the rules made a number of changes that would affect 401k plans. The Secure Act increases the automatic enrollment cap from 10% to 15% of employee compensation in safe harbor 401k plan design alternatives known as a qualified automatic contribution arrangement, or a QACA. Therefore, safe harbor 401k plans with automatic escalation features can allow automatic employee deferrals to be increased over time up to 15% of pay. But remember, this cap is a maximum, and therefore QACAs cannot exceed automatic enrollment at 15% of pay, whereas under prior safe harbor 401k plan rules before the Secure Act, the maximum automatic enrollment percentage was 10%. While the Secure Act's increase in the maximum QACA percentage is effective in 2020, safe harbor plan sponsors are not required to adopt or implement the increase. In other words, it's an optional or a discretionary increase, and therefore continuing to apply the prior 10% maximum will not affect the plan's QACA safe harbor status. For those plans that adopt an increase, the change will have a number of implications. For example, enrollment procedures and participant notices, including processes to capture annual increases, will all need to be updated. Plan document amendments would be required ultimately, and summary plan description updates. And there could be a potential increase in employer matching contribution expense to the extent the plan satisfies the safe harbor requirements through a matching contribution as opposed to a non-elective or a profit-sharing contribution. The SECURE Act also includes provisions that are designed to give greater flexibility to those plans that satisfy safe harbor 401k plan rules by making non-elective contributions instead of employer matching contributions on the employee elective deferrals. First, the legislation eliminates the safe harbor notice requirement for those plans, but the requirement that employees be allowed to make a change to their deferral election at least once a year, that remains in the law. It's important to note that the change eliminating the notice requirement does not extend to those safe harbor plans that use employer matching contributions. Therefore, for safe harbor plans that only provide for safe harbor matching contributions, an annual safe harbor notice will still be required both upon enrollment as well as each year thereafter. The SECURE Act also allows plans to be amended to change safe harbor status through non-elective contributions, and this change can be made at any time before the 30th day before the close of the plan year. Previously, under prior law, mid-year plan amendments to safe harbor plans were very limited. However, pursuant to the SECURE Act changes, non-elective safe harbor status can be amended after the standard deadline if a non-elective contribution of at least 4% of compensation, rather than at least 3%, is made for all eligible employees for that plan year. And the plan also has to be the amendments need to be adopted no later than the last day for distributing excess contributions for that plan year. So for calendar year plans, that would be by the close of the following plan year. These provisions are also effective beginning after December 31st, 2019. So those are in place now, and you can begin to take advantage of them. The SECURE Act will also require, and I repeat, this is a requirement, it's not a discretionary change, but the SECURE Act will also require 401k plans to allow long-term, part-time employees to participate. For purposes of this new rule, those employees who work at least 500 hours per year or at least 3 consecutive 12-month periods and have attained at least age 21 by the end of that period have to be permitted to make elective contributions to the 401k plan rules. Under prior rules, part-time employees could generally be excluded indefinitely as long as they didn't work at least 1,000 hours in any 12-month eligibility computation period. Importantly, this new requirement only applies to elective contributions, and therefore employers are not required to make employer matching or profit-sharing contributions on behalf of the long-term part-time employees. Also, these employees can be excluded for purposes of non-discrimination testing. While this provision of the SECURE Act...
Excuse me, Kerry?
Yes,
Kerry, let me jump in. What that means is that even if you have an individual who satisfies the rules with respect to being a long-term part-time employee, they have the 500 hours in each of 3 consecutive years, et cetera. They also have to be in a class which, if they were full-time employees, would be included in the plan. So you can still, under the discrimination rules, if you've got a plan, for example, that only includes hourly employees, and you've got a part-time salaried employee, that salaried employee would be excluded from that plan. Even if they were full-time, they can still be excluded as a part-timer because they're not in an included class. Sorry to interrupt, Kerry.
That's fine. That's a very good point. Another good point to make is that while this provision of the SECURE Act is effective for plan years beginning after 2020, for purposes of counting the 500 hours per year, hours of service before January 1 of 2021 are not required to be taken into account. Therefore, under this 3-year rule, no employees will be required to be allowed to participate in the 401k plan solely as a result of this new rule before the 2024 plan year. However, because the new rule is effective in 2021, 401k plan sponsors and plan administrators, they should be thinking now about administrative process changes that may be needed to implement, to track hours and or transfers of eligible employees from part-time to full-time status and vice versa, and to otherwise operate in compliance with the new requirement. Additional interpretive guidance is needed as there's some unanswered questions, and so we're continuing to monitor the technical releases for additional interpretive guidance and generally recommending that our clients do the same thing.
Right. The main thing is that you're going to have to be able to capture the hours of these part-timers beginning in 2021, even though the earliest a part-timer can get in would be 2024.
That's right. Thank you for that, Ian. The Secure Act also prohibits participant loans through credit cards or similar arrangements. This provision of the Secure Act was effective immediately upon enactment, and I personally have never seen a plan that distributes principal on a plan loan through a debit card or a credit card type of arrangement. However, if your plan did this or if you were considering implementing this type of a loan method, it's no longer permissible after the Secure Act. The Secure Act allows participants in qualified defined contribution plans and IRA owners to also take withdrawals of up to $5,000 of expenses related to the birth or adoption of a child without being subject to the 10% penalty tax on distributions before age 59 and a half. These withdrawals are permitted to be taken for up to 1 year following the birth or the legal adoption. And notably, the Secure Act provisions include provisions for repayment or recontribution of those withdrawals over time. And I think here it's important to note that that repayment that may occur over time might not necessarily be to the same plan from which the withdrawals were taken. A participant, I believe, may be able to subsequently contribute that money to an IRA on top of any other, contribution limits. For example, where he's no longer employed by the employer whose plan was the paying agent of the withdrawal. This provision applies to distributions that occur after December 31st of 2019, but there do remain a number of open questions here as well. For example, some have questioned whether qualified plans are required to permit these distributions. I think it's a discretionary thing for the employer. And it isn't clear how long participants must be allowed to repay the distributions after they've been taken. Similar to hardship withdrawals for childbirth or adoption expenses, they're not eligible to be rolled over into another plan or an IRA, absent the re-contribution provision. And they're also not subject to mandatory 20% withholding. Instead, they're subject to 10% withholding unless the participant elects out. The Secure Act also includes some relief provisions for defined benefit plans, which I'll just touch on very briefly. Relief was enacted for those pension plans that are soft frozen. Those are plans that are closed to new participants, but employees who became participants before the freeze date often continue to accrue additional benefits for services after the plan participation was frozen. As a result of regular attrition over time, these plans tend to favor highly compensated employees as a result of tenure and compensation increases, and thus over time such plans might become discriminatory absent some other relief or accommodation. The Secure Act provides that relief in the form of expanded cross-testing opportunities, that is, aggregating those soft frozen defined benefit plans with defined contribution plans and testing on the basis of equivalent annuity values, and includes allowing cross-testing with certain employer matching contributions in a 401k plan as well. The Secure Act also includes provisions affecting minimum funding for community newspaper plans and PBGC premiums for cooperative and small employer charity plans. And finally, one last point on defined benefit plans that didn't make it onto the slides is that the Secure Act does also reduce the age at which a participant can be permitted to take an in-service withdrawal from a defined benefit plan. It's reduced to age 59 and a half rather than age 62 under prior law. And this provision is effective for plan years beginning after December 31st of 2019 as well. If we could move to the next slide, please. Ian, would you like to tell us about some fairly significant provisions of the Secure Act which affect minimum required distributions?
Absolutely, Kerry. And let me mention here, a lot of these provisions that we've discussed and will discuss with respect to the Secure Act will require plan amendments. Those amendments can be made as late as the end of 2022 retroactively due to a special retroactive provision enabled by another provision of the Secure Act itself. So I wouldn't worry at this point with respect to the provisions that you're going to take advantage of in terms of running out and doing an amendment to the plan. What I think you ought to be doing as plan sponsors is determining how you want to react to these provisions and then communicate them, because they're not going to do employees any good if they don't know they're there. Going on to another provision that I think is very impactful and will also require communication is new rules with respect to our old favorites, required minimum distributions. As you know, under old law, former participants and significant owners of a company had to, even if they were active employees, had to start receiving their distributions from the plan not later than the April 1st following the calendar year in which the individual attained age 70 and a half. And I've spent the last 46 years trying to figure out why it was 70 and a half, where that half year came from. And although I have suspicions, I still can't figure out why. But effective with respect to participants who attain age 70 on or after July 1 of 2019, required minimum distributions do not have to be made until age 72. Now this is already effective. It was effective for RMDs that would have otherwise been would be in the chute this year. That, to my way of thinking, no, number one, it's going to require a plan amendment, but we already know that plan amendment doesn't have to be done until the end of 2022. But what it, in my judgment, does require is immediate plan communication to at least impacted employees, because number one, there's planning issues that have to be addressed. People are expecting to receive distribution. We're expecting to receive distributions this year, or in April 1st, that they may not have gotten depending on how your plan reacted. They may, in addition, there are people, if your plan didn't react fast enough, who received what you and they thought was a required minimum distribution that wasn't. Those people have the right to do rollovers of that amount to IRAs. So I think communication is in order. This will also interact with another provision in the CARE Act that we'll deal with later, respecting or impacting required minimum distributions that I think that, well, we'll talk about that when those come up. And even, well, an equally impactful change to the required minimum distribution rules has to do with distributions to beneficiaries of participants following death. It used to be that it was possible for a beneficiary of a deceased distribution, in virtually all cases, to be able to what we call dribble out money during their life expectancy, which, if the beneficiary didn't need the money, enabled a tax-free appreciation of a lot of money that would otherwise have been distributed, and was used also as an estate planning device, both by the participant and, if the plan was flexible enough, by the beneficiary. Those rules were tightened up. They've been, for years, they've been considered abusive. And now we have a situation where, effective as to participants who die on and after 12/31 of 19, meaning 1/1/20 and beyond, the distribution must be made over to a beneficiary, has to be made over no longer than 10 years following the year in which the participant died, except where the beneficiary is a surviving spouse, a minor child, a disabled person, a chronically ill person, and I'm not entirely sure what the definition of chronically ill is, or a person who is not more than 10 years younger than the participant. So this is going to prevent a participant from naming a grandchild, passing away. The grandchild may be 9 years old, and it allows tax-free appreciation of money for, decades and decades. I think my own feeling is that this requires a pretty immediate action. Number one, plans should, if nothing else, contact participants with very young beneficiaries, if they can isolate them, to let them know that what they may have otherwise planned is no longer in effect, and that if they want to change their beneficiary designations, they have the right to do so, etc. In addition, these participants, and this is for all participants, should be told that these rules change, and this may very well have an impact on their estate plans, and that participants should contact their estate planning counsel to ensure that this doesn't invalidate a portion of the estate plan and require changes to their wills. Very important provision, and it's effective right now. Let's see, I think, if I'm not mistaken, that that concludes our overview of the Secure Act. And for those who are not of faint of heart, what I would like to do now is go into the provisions of the CARE Act that impact retirement plan benefits. No, oh, wait, Kerry, I blew over a slide. Did I not?
Yeah, I think you were.
Okay, I'm sorry. I didn't mean to step on your slide. Go ahead, Kerry.
No worries, no worries. I thought you were trying to make up some time, so that's quite all right. But thank you for that explanation of required minimum distributions. I'll just make a couple of quick comments on this slide. There are several provisions that may be of particular interest to employers who are thinking about adopting or implementing a new retirement plan or changing the design of an existing plan. For example, in an effort to make it more affordable for small businesses to set up retirement plans, the Secure Act increases the tax credit that's available to the small employers for plan startup costs for tax years beginning after December 31st of 2019, so it's in effect now. The legislation increases the maximum dollar amount to a tax credit for those small employers of up to $5,000, and the credit can apply for up to 3 years. In addition, to encourage automatic enrollment and thereby increase employee participation in higher retirement savings, the Secure Act also creates a new tax credit of up to $500 per year to employers to defray the startup costs for new Section 401k plans and simple IRA plans that include automatic enrollment features. This credit is in addition to the plan startup credit that's allowed under present law and would be available for 3 years as well. And this credit would also be available to employers that convert an existing plan to an automatic enrollment design. There were a number of other administrative improvements in the Secure Act. Before the Secure Act, a qualified plan had to have been in existence by the last day of the taxable year. This was significant for purposes of both employee accruals under the plan as well as employer tax deductions for contributions to the plan. The Secure Act allows businesses to treat qualified retirement plans adopted now before the due date for the employer's tax return for the taxable year, including extensions, to treat the plan as having been adopted as of the last day of the taxable year. This additional
So for a calendar year plan, that's September 15th.
That's right. Well,
if
it's a corporate sponsor, partnerships have different tax return deadlines.
Right.
But the additional time to establish a plan is intended to provide flexibility for the employers that are considering adopting a plan and the opportunity for employees to receive contributions for that earlier year in order to begin accumulating retirement savings. There are also increased penalties for filing the Form 5500 late, as well as the Form 8955 SSA, and these increased penalty provisions apply to returns, statements, and notifications that are required to be filed or provided after 2019. And with that,
now, Kerry, excuse me, think about how that interacts with the multiple employer plan and PEP provisions. The increase in penalties is an increase of 10 times, potentially. And if you've got a multiple employer plan or PEP provider that takes over responsibility for the generation and filing of these forms, that's going to be a real impetus for, small and medium-sized employers to adopt those multiple employer plans and PEPs and get the monkey off their back.
Well, I think that's exactly right. I mean, and with these increases, there are significant dollars then on the table for those MEPs and PEPs that have late filings.
I mean, consider the failure to file a 5500 that could have a potential penalty of $150,000 under the new rules.
Yeah, it could be staggering.
Yeah.
So, Ian, would you like to tell us about some of the retirement plan provisions in the CARES Act?
Yes, very briefly. I'd like to spend a few minutes. There's effectively 4 retirement plan provisions under the CARE Act. Now, remember, the CARE Act and its retirement provisions are intended to enable participants suffering financial hardship due to the coronavirus emergency, access or expanded access to money in their retirement plans. So try to put this into that perspective, and it starts to, at this time, make a little bit of sense. The first is that at any time during calendar year 2020, a plan that permits it, it's not required, but can permit a participant to take a penalty-free withdrawal, meaning an early retirement penalty, an early distribution penalty-free withdrawal of up to the lesser of 100% of the account balance and $100,000 if the withdrawal is due to a coronavirus-related issue. In order for the participant to satisfy the requirements for this withdrawal, they have to state or opine that they are the spouse, individual, or dependent. The withdrawal is being made because the participant spouse or dependent has been diagnosed with the coronavirus. The participant experiences severe financial consequences due to a quarantine, furlough, layoff, reduced hours, or inability to work due to a lack of child care due to the pandemic, or other circumstances promulgated by the Secretary of the Treasury. Obviously, the Secretary of the Treasury has not acted yet, but the expectation is that these circumstances will be read broadly. The individual, if they take the distribution, number one, there's no premature distribution penalty tax. Number two, the tax on the withdrawal can be spread over 3 years. And in addition, the participant has the right to repay the amount of the withdrawal into the plan over that 3-year period, at which point it won't be taxable. Number two, the maximum amount of a loan during the 180-day period, taken during the 180-day period following date of adoption, which was about 2 weeks ago, is increased from the lesser of 50% and $50,000 to 100% of the account balance, or $100,000 during that 180-day period. The reasons for the loan are the same as the reasons I stated above with respect to distributions. The plan in both the withdrawal and the loan situation does not have to verify that the statements made by the participants as to the reason why they're taking they're applying for either the withdrawal or the loan are true. They can rely on the participant's statements. A second facet, unrelated with respect to loans, is that any loan payments that would otherwise be required during 2020 can be abated, meaning that loan repayments during 2020 don't have to be made. If they are in 2021, we believe that the loan has to be re-amortized so that it is completely repaid by the end of the period under which the original loan was made. In other words, if I've got a 3-year loan and this is year 2, I've made my payments in year 1. I don't have to make my payments in this year, which is year 2, because it's 2020. In 2021, the loan payments have to be re-amortized so that I've completely paid the loan off by the end of the year. Number 3, no RMD payments have to be made in 2020. Payments that would otherwise have to be made in 2020 have to be made in 2021. This is kind of difficult if you've already made the payment, and that's going to require an employee communication, letting them know that they can roll over. If the plan has been up to speed on this and has stopped those payments, it seems to me you've got to get to the employees who may have otherwise been relying on the receipt of the payment and tell them in some way, shape, or form they're still eligible for it, either through a withdrawal or some other type of an election, which may or may not require a plan amendment, depending on how the plan is written. But once again, these plan amendments don't have to be made until 2022. Real quick overview. I don't know if you're as breathless as I am, but we're going to wind up with a description of the CARE Act impact on the health insurance provisions. Kerry, you're the cleanup batter. Go for it.
Thanks, Ian. Before I do jump to health plans, though, real quickly, there is one additional point I wanted to make about those coronavirus-related distributions that you mentioned at the beginning of your discussion about the CARES Act changes to retirement plans. And that is that the change for those distributions, the way it was added to the tax code, it was added as an exception to Code Section 72T, which is what imposes the penalty tax, the 10% penalty tax on employees or participants for distributions before age 59 and a half. Even if the employer does not choose to adopt the coronavirus-related distributions as part of their plan because it is a discretionary provision, if that
you're right.
If that participant is otherwise entitled to a distribution from the plan because he or she has terminated employment or for whatever reason, that participant still could claim the exclusion from the 10% penalty tax on his or her own federal income tax return. And so I think that that's important for employers to note, to explain to employees if for some reason they're not adopting that provision.
Good point, Kerry.
So having said that, I'll just cover some changes to health plans that were included in both the 2020 Appropriations Act as well as the CARES Act and some of the other pandemic relief that's recently been adopted or announced in response to this whole COVID-19 pandemic. In the 2020 appropriations legislation, the health plan changes are not part of the Secure Act technically. They're included as part of the Health and Human Services extenders that are included in Division N of the appropriations legislation. And to me, the most significant, or I guess maybe the most surprising thing, to me, the extension of the Patient-Centered Outcomes Research Institute or trust fund fees was a surprise and was likely the most noteworthy impact on employers, particularly those who sponsor self-insured health plans. As history, the PCORI fees were enacted as part of the Affordable Care Act and were originally intended as only a temporary 7-year excise tax. For fully insured plans, the fee is assessed on and is paid by the insurance company, although it's generally passed on to the consumer in the form of increased premiums. However, for self-insured plans, the fee is assessed against and paid by and reported for tax purposes by the employer. In either case, the PCORI fee is a per enrollee fee. It started at $1 per enrollee and was indexed for inflation, so that ultimately, I believe for the 2019 plan year, or perhaps the 2018 year, the fee is $2.45 per enrollee. The 2020 appropriations legislation extends the PCORI fee for 10 years. So now it's going to be applicable for plan years ending before October 1st of 2029. So the 2018 plan year would be the last year that, the 2028 plan year would be the last year that a calendar year plan has to pay the fee according to this extension. The legislation did not change the method for filing or reporting the fee and paying the tax. It's still reported on IRS Form 720, and the tax is payable at that time, which is due by the last day of the 7th month after the end of your plan year. Unsurprisingly, the appropriations legislation also repealed the excise tax on high-cost employer-sponsored health coverage. This is an excise tax that was also referred to as the Cadillac tax. The repeal of this excise tax had strong bipartisan support for a very long time before the Appropriations Act. So its inclusion in that act was no big surprise. And interestingly, therefore, the repeal, because it applies to taxable years beginning after 2019, the repeal is effective before the excise tax itself ever actually went into effect. It was intended by the Affordable Care Act to go into effect a few years ago, but because of a lack of guidance, it kept being delayed, and there were cries to repeal it, and now it has finally been repealed. The tax legislation the appropriations legislation also repealed a few other taxes that were imposed as a result of the Affordable Care Act. They were not of particular interest to employers because these were fees on health insurance providers, and there was an excise tax on medical devices. But one interesting provision that was in the appropriations legislation is a provision that provides for re-enrollment of individuals who enroll in their health coverage through the public exchanges or through the marketplace. This re-enrollment provision applies for 2021 enrollments for individuals who are enrolled in health coverage in 2020 through a state health exchange, also known as the marketplace. That's only those, though, that are run by the Department of Health and Human Services. If such individual resides in a state with an exchange that's run by HHS, and they do not otherwise enroll for 2021 during the annual enrollment period or make an affirmative election to disenroll. The CARES Act also includes a few provisions that affect health plans. For those who've been following the news closely, you'll be aware that there have already been several rounds of relief legislation enacted at the federal level as a result of these extraordinary times. Several weeks before the CARES Act, Congress had passed the Families First Coronavirus Response Act, which greatly expanded unemployment and leave programs, but those are outside the scope of what we wanted to talk about today. The Families First Coronavirus Response Act, though, did have one provision affecting health plans, which requires coverage for diagnostic testing for COVID-19 without cost sharing. Then the CARES Act was passed a few weeks later, and the CARES Act then expanded upon the Families First Coronavirus Response Act by expanding the types of testing for COVID-19 that have to be covered with no cost sharing. So now plans are required to cover without cost sharing tests for which the developer has requested or intends to request emergency use authorization, and several other categories of tests. Importantly, though, the CARES Act does not include any requirement that requires plans to provide first dollar coverage for actual treatment of COVID-19 related medical expenses. However, there were some relief, not part of the laws that were enacted, but announced by the IRS in IRS Notice 2020-15, which predates the CARES Act, that ultimately says that high deductible health plans that cover testing as well as treatment, the IRS notice allows you to cover treatment as well, that first dollar, that's not going to jeopardize that plan's status as a high deductible health plan. One last provision that I'll mention real quickly under the CARES Act, because this was also, this is another surprise to me, but the CARES Act eliminates the requirement to have a prescription for reimbursement of over-the-counter medical products for healthcare flexible spending accounts under Code Section 125 cafeteria plans, health savings accounts, health reimbursement arrangements, and Archer medical savings accounts. This provision is not temporary because the coverage for treatment under the high deductible health plans that I mentioned earlier, that is a temporary provision. But this provision is not temporary. And thus, the effect of it is that it completely eliminates the significant Affordable Care Act revenue raiser. And it applies for amounts that were paid from these types of healthcare defined contribution accounts after 2019. So it's effective for all expenses that are reimbursed during 2020. That's just a real quick recap of some of the health plan changes. There have been some interpretive guidance already issued in the form of DOL FAQs, which are also very helpful. And so I would recommend that plan sponsors and their plan administrators pay attention to that additional interpretive guidance as well.
Well, as you can see, we have a full plate on our hands in the benefits area, as well as a lot of other areas. We want to thank you. We've enjoyed the session, as breathless as it's been. And we look forward to a time when we can do these sessions in person again. Everybody stay well. Kelly, it's back to you.
Wonderful. Thank you so much, gentlemen, and thank you all for joining us today. We really appreciate your time, and certainly Ian and Kerry, we appreciate all this information and your expertise. We also look forward to seeing you all again in person. I hope you guys have a great afternoon. Bye-bye.
Stay well.